Hello and welcome to Livewire's listed series for 2026, where we're helping investors navigate an ever-changing investment landscape. My name is Chris Conway. Today I'm joined by Cameron Gleeson from Betashares, an ETF provider that is often on the cutting edge of that change. Cameron, welcome.
Chris, thanks for having me.
As noted in the intro, Cam, we're living in a very rapidly changing world. Talk to me about how Betashares is navigating that change and how you're providing new and targeted opportunities for Australian investors.
Betashares prides itself on being able to help investors both grow and protect their wealth, and we're recording this 10th of March. There's obviously conflict in the Middle East. It's interesting to note some of the flows that we've seen into funds that we'd consider a geopolitical hedge into our oil-based ETFs, OOO or fuel. We've also seen investors gravitate towards ARMA, which is our global defence contractors ETF. So it's just really about providing all sorts of vehicles so investors can handle all sorts of situations. Another aspect we tend to see in these periods of volatility is that Australian investors will tend to pivot away from global equities and back to Australian equities. And I think the Australian equity market is quite a nuanced market. We talk a lot about the challenges of stock picking and fundamental analysis leading to outperformance in Australia. We know what the overall results in terms of active management outperformance look like, quite dire. And so Betashares wants to offer tools that can help investors, whether that be the lowest cost broad market index exposure in A200 or rules-based systematic factor exposures that can help investors outperform after fees over the long run.
We'll talk about some of those factor ETFs in just a moment, but I just wanted to touch on the makeup of the ASX. As you know, heavily dominated by banks and miners, around half of the ASX 200 these days. Some investors lean into it, some investors try and steer away from it. How does Betashares think about it?
Yeah, some of our first ETFs were in fact sector ETFs. So you could back your view by investing in a sector ETF in either the resources sector, for example, QRE, or in the financials, QFN. ETFs are all about choice, and we know that some investors are going to want to take these tactical tilts, whether it be through investing directly in stocks or through these ETFs. But I think for the majority of the investors, sometimes all of their portfolio is not run with a tactical lens, or at least a large portion will be a long-term core. They want to allocate to asset classes over the journey. And if we think about the Australian equity market, some of the concentration we see in our market, the cyclicality, a lot of the sectors are very cyclical. This is actually sort of a fertile ground, if you like, for systematic factor-based approaches to add out performance over the long term. So we want to provide investors with the tools to either match the market in low-cost beta or indeed add outperformance through what we think are some really compelling value offers in terms of factor exposures.
Very nice segue there, Cam. We're going to talk about a couple of the factor ETFs now. So first of all, just lay out the case for me for factor investing here in Australia, and then ETFs like QOZ and AQLT, what's the thesis there?
Very simply, factor ETFs are a rules-based approach. The ETFs are very low cost versus, for example, active management. And what we've seen is the efficacy of some of these factors over the long run to produce outperformance is very strong. So you mentioned QOZ, which is our Betashares RAFI Australia 200 ETF. This is what I'd call a dynamic tilt to value. It holds the 200 largest companies in Australia, but weighted by their economic size rather than their market cap. And if we go back over the last 4 years, we actually had about a 3-year run where banks were outperforming miners. Now, at the start of that period, QOZ was indeed overweight the banks relative to miners. Over the period, however, we saw a rebalance of QOZ away from banks into the miners. And if we look over the last 12 months, that overweight to miners has paid dividends. So QOZ's up 11% over the last 12 months. It's a tilt to value, but it's also, I guess, a way of playing the mean reversion we tend to see in our banks and miners, and has been a consistent deliverer of returns or outperformance relative to the market over the long run. The other fund you mentioned is AQLT, so our Australian quality ETF. Look, one of the, challenges in the Australian equity market is right now, earnings growth looks really strong because the miners are showing really good upgrades in terms of earnings. But earnings growth, structural earnings growth has been a challenge in the Australian market. Investing in a portfolio of quality companies tends to give you stronger earnings growth. And we think that over the long term, earnings growth is a really precious commodity in Australia. One thing I'd note about quality as a factor though, is you screen the Australian market for quality stocks, you're typically going to upweight IT, consumer discretionary, and you may have no exposure to banks because they tend to screen very poorly for quality. AQLT is built differently. It's built for the Australian market. We still have a weight to the top stocks in the market, but we weight them by quality. So we still have that anchor of the banks, they're still in there, and we have all the high quality mid-cap stocks. What that's meant is in that period when banks outperformed, AQLT kept up with markets and indeed outperformed. So it's returned since inception, more than 3% outperformance, which is quite incredible, and it's produced great results in all sorts of market conditions.
Cam, another factor for an Australian investor is, of course, income. Aussies love their income, as you would well know. Talk to me about a strategy like high yield. How does it attempt to provide investors with income, and how does it differ from, say, traditional income strategies?
Yeah, so HYLD is designed to be an exposure to Australian equities, which is going to give you that broad market exposure, but an uplift on the income. So roughly 30% higher dividend yield versus the broad market. And the way it does that, which is not uncommon for, if you like, rules-based or index tracking yield ETFs in the Australian equity market, is to use forecast dividends. That's not new, that's been done. There are other products out there like that. However, what HYLD does differently is two things. It doesn't just rely on those forecasts, because sometimes those forecasts can be stale. It uses market signals. What's the momentum? What does that overall expected yield look like? Is it basically at a level which is unsustainable? What does the risk look like relative to the yield? So using these other market-based signals, it tries to identify and eliminate what we call dividend traps. And this can be the bane of any dividend investor's sort of returns. Further to that, we know that a lot of income-oriented investors want to see more regular dividends or distributions. So the ETF distributes monthly. That consistency of income is a really strong feature versus, for example, holding the bank stocks where you get 2 dividends a year. So it's consistency of dividends or distributions. It's consistency of removing the risks of dividend traps, but the strong overall yield together with a market performance, which makes HYLD a really strong package for people who are looking for income.
Cam, you touched on the top about the conflict in Iran. Just before that, the SaaS apocalypse,
Yes.
tech stocks, very topical.
Yes.
Talk to me about ATEC and the opportunity that provides and how it differs from tech exposure in the US.
ATEC tracks the S&P All Technology Index. It's Australia's technology index. As a sector, IT only represents 2% of our broad market, but it has been absolutely in the news through this earnings season. We saw that typically a lot of these companies produce strong growth, maybe some of them slightly disappointed versus expectations, sold off heavily with negative sentiment. It's really interesting to note that one of the strongest ETFs for inflows across February was in fact ATEC,
right,
across all Australian ETFs.
Yeah.
Exactly. A lot of investors interested in buying the dip. They believe that some of these names have a reasonable moat around them, cheaper valuations, and opportunity to participate in upside. So that's been a really interesting trend to see. And for Australian investors who think that 2% in IT is not enough in their Australian equity exposure, ATEC provides that uplift, which can be really useful for an investor who wants to do so.
Cam, talk to me about an investor that might already own a broad ASX ETF. How might they think about layering in exposures like QOZ? We've already spoken about AQLT again. What does that look like?
Yeah. So there's different ways that you might look to implement your Australian equity portfolio. For a lot of investors, they'll simply be looking to drive good solid returns, and they may not be overly benchmark aware. So I would be thinking about something like AQLT. Our market is, as we know, very cyclical in its very nature. Adding quality to cyclicality is a really good complement. But if we think about, for example, the Betashares managed accounts that we run, I sit on the IC, we don't believe in timing factors, so we don't necessarily think it's easy to pick when value or quality is going to outperform. We actually seek to combine some of these factors. So quality and value, their relative returns historically have been negatively correlated, which provides you diversification benefits. So over the long term, strong outperformance, but offsets, lowers your volatility. So that's the way we build our portfolios, but different investors will have different approaches that they use.
Last one, Cam. Australian investors oftentimes use direct equities for the Australian equities portfolio, a sleeve of their portfolio, and then ETFs for international or thematic exposure. What are they missing if they do that and don't use Aussie equity ETFs or Aussie ETFs?
That's historically been the case, hasn't it?
Yep.
Australians have loved their direct stocks. If I look at my mum's portfolio as an example, she's done very well. She's got a large position in CBA that she got in the IPO and DRP'd her way through, and that dominates her portfolio. It's actually quite a tilted portfolio, but there's a lot of risk there. I think also just, that aside, if we think about the events of the last week and a half, markets can be incredibly dynamic and change on a dime, and that can really catch you off foot. The great thing about these factor ETFs, I talked about QOZ or HYLD or AQLT, is that they're rules-based. The efficacy of those factors over the long term has been proven. And not only are they something that can drive strong returns, they're very low cost. Versus trying to execute any of these sort of strategies off your own bat. With a brokerage, you might face the market impact costs of trading. I think what you'll find is that using an ETF is a far more cost-effective approach and a far more consistent approach.
Cam, thanks so much for sitting down with
You're
Livewire
welcome,
for our
Chris.
listed series.
Great.
If you enjoyed that interview, why not check out the rest of the listed series content available on the Livewire Markets website.